In this video, we introduce interesting accounting issues that emerge with debt. We're going to cover specifically the following: paid-in-kind loans, or PIK loans, as well as the resulting accrued interest and the interesting impact that it has on the three financial statements. Then we are going to cover loans issued directly for building long-term assets, as well as the resulting capitalized interest. Next, we turn to bonds that are issued with an original issue discount. An original issue discount is when you issue a bond with a value that is less than the face value of that bond. And so we're going to cover two specific types of bonds that have original issue discounts. One is the most obvious original issue discount, and that's the zero coupon bond. That's where you don't provide, and you as the borrower don't have to pay any coupon payments throughout the life of the bond, but obviously that comes with a very strong original issue discount. You're going to receive from the lender far less than the face value of the bond. The interest is sort of implicit within that original issue discount. And next we turn to coupon bonds that have an original issue discount. And lastly, we're going to wrap up with sort of the flip side of that, which are bonds that are issued with an original issue premium. Let's turn to paid-in-kind, or PIK loans. So PIK stands for payment in kind and represents a type of loan that we actually frequently see associated with LBO, or leveraged buyout financing, where the borrower does not pay the lender cash interest, but instead interest accrues, leading to a higher principal balance. PIK loans enable borrowers to preserve cash flows, deferring interest payments until a later event, like a sale or refinancing. PIK interest is still recognized as interest expense on the income statement, just like cash interest expense. But instead of cash going down on the financial statements, the offsetting entry is an increase in the loan principal. Since the loan balance increases, the subsequent period's interest will be calculated using the original loan plus the accrued interest. So unlike cash interest, this accrual accrues to the principal balance, and the lender will actually expect interest payments as a function of the original principal balance plus any of the accrued interest. Because PIK interest is accrued, it is added back to net income in the cash flow statement, specifically within the cash from operations section. So let's go through an example to just kind of illustrate how this works. We see a company that borrows $100 million with a 10% PIK interest associated with it. So on day one, it's no different than borrowing a regular loan. There's a $100 million debit to cash from the loan and a $100 million credit to the loan on the liability side of the balance sheet. Now, after year one, you've generated some interest. Of course, it's treated exactly on the income statement the way any cash interest would be treated. It's recognized as interest expense and hits retained earnings as a debit. But here's where it's different. Instead of cash being credited, the loan is credited. The loan goes up by 10. The following year, the interesting thing to note is the following year, at the same 10% PIK interest, the interest expense is 11. Why is the interest expense 11? Because this has accrued to the loan, and now the loan is not 100 balance, the loan is 110 balance, and 10% of 110 is 11. So that's the one thing to be aware of with PIK interest. And obviously the actual principal, along with the accrued interest that now is part of the principal, gets paid off at the end of the term of the loan. One other thing that I'd like to note with regard to PIK toggles, with regard to the PIK, is a concept called a PIK toggle. Now, PIK toggles are a feature of some LBO financings where the borrower has a choice. Specifically, they can toggle between paying cash interest at a certain rate during a given period or elect the PIK, usually at a higher accrual rate. So an example of that would be company borrows $100 million with a 10% PIK and a 5% cash toggle, meaning they can choose from one of these two. So we borrow in the beginning, it's exactly like borrowing any other loan, $100 million in debit to cash goes up, and $100 million credit to the loan principal. Now let's say in the year one, the borrower chooses PIK interest, so no cash leaves the company, interest expense is still recognized, but instead of cash going out the door, the loan is credited on the liability side. The next year, let's say the borrower chooses cash interest. In that case, what's happening is you have a $110 million loan balance. And that's the key to remember. You have a $110 million loan balance at a 5% cash rate. So now cash goes down by 5.5, and cash goes down by 5.5 here. That's the credit, and interest expense, just like with the PIK, is debited. Now, the one thing to note is this is just usually the difference between the PIK and the cash is not so great. We're just sort of giving an example that's a little bit more illustrative. And the other thing to note is, depending on the financing structure, there are many different ways to structure PIK toggles. There are PIK toggles where you don't pay, specifically where it's defined that it'll be a PIK for the first couple of years and then you start paying in cash. So there are many different ways to slice this, but the accounting is always going to be the same for PIKs versus for cash.